Okay, good day, everybody. This is Jim Kenney. I provide the content for the OptionProfessor.com DVDs. And just a quick background on myself. I am a graduate of Boston College, and I have been in the investment area here for over 30 years. So I'm very familiar with all different types of investment, but I have specialized mostly in the education of options in my career. Today, I'm going to be going over a wide bit of information and try to give you some insight and opinion into what I think. Again, as a disclosure, there is a substantial risk of loss in short-term trading as well as option trading, and it's not suitable for everybody. And past performance is not necessarily indicative of future results. You should discuss any investment with the investment firms you're dealing with and discuss the suitability for each situation for yourself. Okay, getting right into it here on current events. We have got a lot of news here today. President Trump is now talking about over $500 billion of tariffs regarding China. And that is obviously some fairly big news. The reality is there's only been 34 billion, as far as I know, of actual tariffs. So a lot of it is still in the talk and threatening stage as opposed to the actual situation. It is important to notice that the tariffs that had been put on did create, and there is some fear that additional tariffs will put a pinch on global GDP, meaning global growth, and will also be problematic for pricing, as some of the products that they put tariffs on, the prices of those items did go up significantly. So there is an inflation risk and there is a growth risk with the tariffs that may or may not be fully discounted in the market right now. As far as news is concerned, otherwise on the earnings front, Microsoft came in and really hit it out of the ballpark and guided higher. And so that stock has been rewarded. I'm going to get into that in a few minutes here. Also, we have Honeywell reporting as well as guiding higher. So that's a news that has been good. Next week, we've got earnings from Google and Amazon. So that's big news coming up next week. And they did an announcement that 2/3 of all the earnings in the S&P this year have come from 5 stocks, and they are Apple, Amazon, Google, Microsoft, and Netflix. So when people say there's high concentration in this advance in a small number of stocks, I think that's what they're talking about. So keep an eye on that. What else do we have here? We got a $5 billion fine against Google, which is supposed to wipe out 75% of their Q2 profits. So we'll take a look at that stock as well. These are things that are in the news and might be of very much interest to all of you. Another thing that I saw was companies that beat earnings estimates going back 15 to 25 quarters. The 2 best stocks at beating estimates are Home Depot and Best Buy. So we're going to take a look at those 2 companies as well. Again, I'm going to be showing you some charts and some different situations here and things that I look at. And I'm also going to discuss what strategies might be considered basis a certain opinion that you might have on the market. And then, of course, you've got to price out the specifics of the strategy and see if it makes any sense. On a quick overview situation, the S&P 500, my view was and is that we had a major advance that occurred in January where we went up to almost 2,900 on the S&P. The market was extremely overbought basis the 200-day moving average, and we've been in a basic consolidation ever since. The high of the range maybe been right around where we are now, 2,800. Some people say give it up to 2,850 because there's a gap up there right around 2,850 that the market may want to go up and fill. And the downside has been moving higher. The downside used to be around 2,550, then it went up towards 2,600. Right now it's around 2,691, 2,700. So the floors are moving higher and the highs are moving higher. So obviously that is a little bit of evidence of an uptrend. With regards to the VIX on a short-term basis, we did hit the 11 area and we did hit 2820 almost on the S&P. And so that is a little bit of an oversold on the VIX, overbought on the stock market S&P. And so in the last couple of days, we have been correcting that differential and we have come back to under 2,800 here today briefly, or yesterday briefly, underneath 2,800. And basically right now 2806 on the S&P, and the VIX, which was in the 11s, is now in the, I believe, the 13 area. Let me just double check here. I'll punch that up for you so you can take a look right now as yourself. There you go. The VIX is at 13. Okay, and it had been as high as 13.58, but it has definitely turned up off the 11 number. That's for sure. Okay, so anything else going on here? I'm going to go into a few different markets on interest rates, the dollar, oil prices, gold, silver, copper, and soybeans to give you a little bit of a roundabout look at everything. Because, like I say, I've been in this over 3 decades, and I'm very familiar with all the different markets. And some of you have different interests than others, but I'm going to start out with some of these stocks that are in the news and see what you think. First of all and foremost, let's talk about that Microsoft. That is a company that is really taking that iCloud business and getting involved and making some money. Right now, we're up at 107.33, as you can see, and you can also see that it is gapped up. So there is a little bit of a gap down there. I don't know if it'll come back and fill it or not. PE ratio right now I'm looking at on the screen here says 50. So again, it is not an inexpensive stock, but is now being priced for future growth. I heard somebody on the TV here, an analyst, talking about a target price of a 150 on the stock. Basically, I think they would be discounting that their revenues and their growth is going to continue to accelerate. And if that's in fact true, then obviously the upside could still be there. We did make all-time highs today at 108.20. So this is a company that that has been doing extremely well. Let's take a look at the detail, though, because I always like to look at the moving averages basis to the price. So let's take a look at that. Okay, so we come down here. And let me just move this screen up when it allows me to. And then we'll be able to see those moving averages. And that'll be helpful. Right now, the short interest you can see is only 0.262. So, there is no shorts in here to speak of. So if you're looking for a short covering rally, that's not going to be happening from the standpoint of, doesn't look like short interest is very heavy. Okay, let's bring this thing back up a little bit. There you go. The average price is 98 on the 50-day, and the 200-day is at 90. So you're about 17, well, let's just figure it out here. $17 above 90 would take us on a percentage basis to about 20% above the 200-day moving average. With the gap that it just had here, you have to be a little careful that it might get a pullback. So if you think that it's going to have a little bit of a run here and then a pullback, and you own the stock, this would be the time to start pricing out the call options above, the 110s, the 115s, the 120s, whatever you think could be a short-term ceiling on the stock, and then sell the call option against it. That's called covered call writing. What that does is it gives you some cash flow coming into the account, and it does give you some downside protection. Let's just say, as an example, theoretical example, you were selling the 110 calls and you were getting $6 for that. That would bring your risk, if the market went down, from the 107 area down towards the 101 area, because as it went down, if the option expires at 0 because the time runs out and it stays underneath the strike, you'd be able to keep that premium. And that would reduce your cash risk to 107. You'd still own the stock and you'd keep the premium. Of course, if it goes sideways, same scenario. If it goes up, you are agreeing to sell the stock at 110 plus the $6 you received. So you're actually agreeing to sell it at 116 as far as where it would be valued in your account as far as the premium plus the strike price. There's adjustments you can make if you think the market is going to keep going. They call it rolling up your position. What that means is you would buy back the 110 call and then move it to a higher strike price, and then you'd stay in the stock and wouldn't have to worry about being exercised. Generally speaking, exercise occurs when there's no premium in the call option, meaning it's in the money, or if there's a dividend to be captured. So there's a lot to learn. Of course, at OptionProfessor.com, we've got the DVDs that give you a lot of details on that. But, selling calls into this rally, if you think this rally will not be following through, that would be something to consider right now. If you're bullish on it, but you think that you'd prefer to get it at a price underneath the market, and you have the cash in your account to pay for the stock, people might be considered selling puts in this environment. And looking at where support might be, well, we already know 90 is the 200-day moving average, and 98 is the 50-day. So some people may be looking at that 100 mark or that 95 mark as strike prices where they would not be afraid to sell the puts. And then, of course, if you sell a put, you're agreeing to buy the stock at the strike price, and you're collecting a premium. So just as an example, say you went 3 months out and you sold the 95 put for $3. You're going to keep the $3 if the stock never comes down and the time runs out. You are going to be agreeing to buy the stock at 95 minus the $3 you received, or 92. So that's where your situation of risk would start coming into play. And of course, with the stock way up here and with all the bullishness to it and all the trend going, there's probably a likelihood that you might keep the premium if this trend and this news continues. So there's a couple of different ways of working with Microsoft. And of course, if you're bullish, if the premiums are large, you might consider what they call a bull call spread. How does that work? That's where you buy a call. Let's say you bought a 105 call and then you sold the 115 calls. That's a 10-point spread. Let's say you pay, I'm just using theoretical examples here, not using commissions or fees or anything else. These are certainly not net numbers. They're meant to be theoretical, but they give you an idea of the strategy. We're at 107, so say you think it is going to be going up, and you buy the 105 call and sell the 115s. That's a 10-point spread. Say you bought the $10 calls for 10, and say you sold the 115s for 4. Well, you buy out at 10 and you take in 4. Your differential there is going to be what? $6. Now, what are you looking for? You'd like the stock to get to 115 or better by expiration. If you hold it all the way till expiration, there's no time premium in the options, and we're at 115 or better, that spread would be worth $10. If you paid $6 and it's worth 10, you added $4 to your 6, and you made out pretty good. If it goes under 105 and all the time runs out, you're going to lose the $6, but you can trade it in the interim. And that's a couple of different ways to work with Microsoft right now. It's obviously very strong with very strong news, but of course we've been around the block more than once, and news and things can change, particularly when we're talking tariffs and this, that, and the other. Okay, that gives you a little bit of look at Microsoft. Let's look at another one that announced today in the industrial sector, which is a sector that people are getting a little bit bullish on. Financials and industrials, people are starting to get constructive on here. Honeywell. And Honeywell today guided higher for the rest of the year, and people are getting into the stock. So now where are you? You're at 151 and change. That's up 2.5% almost today. And it is still what? It's still $14 under its 52-week high. So some people may think that there could be some real estate above it, that it might get filled in. And certainly today, looking at the chart, the momentum does definitely look like it's going to the upside. It yields, according to this screen here, 197. P ratio is a little bit on the high side there, according to this screen. But let's look at the detailed quote and see where the moving averages are, basis the price. I like moving averages. They're based on time and price. They're not based on, people's opinions. They're not based on some guy who you met at the golf club or whatever. It's based on factual information of time and price. And so it does give you a little idea of what has happened, and it does give you a little idea of money flow. Now, if you look here, this thing went to 165, and then it's been chopping around that 145 area for a while, and it looks like it's trying to make its way back above 150. To get this thing really going, you're going to have to print this thing above 153 probably to really get above that resistance that it's been having. But you are looking at the 50-day and the 200-day there under the market now. The only bad thing you would say is that it's still inverted. What does that mean? That means your 50-day average is 145 and your 200-day average is 148. That's not particularly bullish. What you'd like to see is the 50-day being above the 200-day. That's not happening now, but the price is above it, and with them guiding higher, and if this S&P is going to have a rally going into the end of the year, this could be a company that might benefit from that. Certainly if we got above 153 and then 155, taking out that 165 probability would be increased dramatically. Keep an eye on this one because, again, it has some good news fundamentally on it. Technically, it is back above its averages. So keep an eye on this one, and it could be a beneficiary of the second half of the year if things pan out to the upside. Okay, another one that is out there today is GE. You know, they announced that they had, well, actually, what they did is they did better than people thought, but their earnings per share were still 10% lower than a year ago, quarter to quarter. And that's why the stock's down 4%. In other words, they had the party hats on this morning, brought it up to 378, and then everybody got some hot coffee in them, and they realized that their improvement over the estimate was still not a very good number. So, and I don't think everyone trusts their turnaround story just yet. Looking at the moving averages on GE, though, because there are some people who are constructive on it, and it certainly is way down in price on a historical. Let's take a look at the moving averages. Yeah, see, the moving averages are still inverted to the downside with the 200-day at 16 bucks. So there's still a cloud above this thing. And so you'd be a little bit careful. But it is trying to make a bit of a turn, but it could have a lot more work to do. And if it has any more bad news coming out, taking out the lows is certainly not out of the question because it's in a pronounced downtrend. Okay, anything else out there that we can look at for you guys here today? Skechers, yeah. They came out and they missed their numbers, and they are being punished handsomely here. So let's see if I can get that. I don't have that symbol right in front of me. So let's see if I can get that up here real quick. Hold on. Skechers, SKE. Well, I'll tell you what. I'll come back to Skechers because I don't have that symbol right in front of me, and I want to move forward because there's other stocks to talk about. Remember, I talked about the two stocks that in the last 15 to 21, 22 months, quarters, excuse me, have been beating on their estimates and their earnings. Well, two of them are Home Depot and Best Buy. So Best Buy got a guy coming in from France, I guess. I was just hearing, and supposedly he has done a great job using the online marketing and some other ways of making the experience at Best Buy, trying to combine a personal experience with an Amazon experience, and it has been a very, very good situation for them. Just look at the 52-week low of 51 and the 52-week high of about 80, and you're looking at almost a $30 run on off the low of 50, and that is in terms 60% up. Nothing wrong with that at all. Now, right now it's at 77 bucks. And it is having some trouble at that 80 mark, so you got to be a little bit careful here. But people are saying that they're on track to keep going here. Let's look at the moving averages and see if that might give us an indication of what the flow of money is and what the traffic looks like. Okay. The 200-day moving stock's at 77 and change, right? And you got a good situation here. You got a 73 on the 50-day, and you got a 68 on the 200-day. So they were inverted to the upside. That's not bad. The only thing is we are about what? 10 bucks above the 200-day average. So if you take 10 bucks and divide it into the number, you are looking at about 14% above the 200-day average. So that would get you thinking that it could have some type of pullback, you know, getting a little closer to its moving averages. Doesn't have to do that. It could take off right here, right through 80. But again, if you want to be a little bit more price conscious, this 75 area looks like it would be fairly significant support. And then basically, you know, that would be right around your 50-day average, right? 73, 75 would be some support. And then, of course, if it dipped a little bit through that, you'd want it to hold on to the 68. So if you're, you know, in a bull market, sometimes people like to buy the pullbacks, right? Because on a pullback, it's only going to be temporary if it's a bull market. And then, bam, it goes back up. Strategies for this thing, you know, again, not dissimilar to what? To the Microsoft strategies. If you think it's a little bit overdone here, you might investigate selling some calls against your stock and see if you think it makes any sense. And then, of course, if you would like to buy it at a discount to the current price, you could try to sell a put if you have the cash in your account to buy the stock, if it's put to you. Again, when you sell a put, you're agreeing to buy the stock at the strike price until it expires, and it's the strike price less the premium that'll be your cost as you come out of it. As you're figuring, you know, premium off of the strike price. But again, Best Buy and Microsoft have some similarities. Very strong, but they're on their highs or near their highs, and they're a little bit further away from their moving averages, so they could be susceptible to a pullback. But they also are so strong they could blow through as well. All right, the other one was Home Depot, right? Let's take a look at Home Depot, see what's going on there. Okay, on Home Depot, you are, again, very similar to the Microsoft and the Best Buy. 207's been the high, and it's currently 203 and change. And basically, it's up a little bit today. Again, it's coming up against this resistance in this ballpark area of around 200 to 207. It's, going to, let's just see. I'm looking at the moving averages for you to get an idea where we are versus the overall moving averages. None of these stocks have very much short interest in them, obviously, because they've been rallying so well. So you don't have that short covering possibility as much. Okay, right now, this one again, it had a great pullback to its 200-day average. I had talked about this earlier when it had the pullback underneath 180. If you were going to take a shot at Home Depot on the pullback, when it went from 210 down to 172, which was basically the 200-day average, that was the time to hit it. And obviously, you'd be benefiting quite a bit right now. I don't know if it's setting up for the same scenario, but the 200-day average is down at 182, which means it's 20 bucks underneath. And that is, on a percentage basis, about 11%. Not a tremendous amount away, but it does give you some real estate between 182 and 203 that it could come back and fill. And of course, on that dip, if you're a believer in the company, and who wouldn't be the way they've been going, that would be an opportunity to take advantage of the dip. Again, people here might sell puts underneath the market because they believe the company is uptrending. And those people who think it might have trouble getting through 210 might take advantage of the high price and look for some covered call opportunities up here as well. Okay. All right. So those are some of the stocks in the news, and I just thought I'd run through them for you. Hopefully that'd be a little bit helpful to you. Right now, I'm going to go through very quickly here a number of other markets before I sign off. Again, I already went over the S&P 500. Let's go back. Let's go back to that and see what's going on here. And let me just go through these briefly because we have covered a lot here today. Okay, on the stock market, the S&P, where are we currently at? We're at 2806. Again, there's that gap up there at 2850. The market may make a run at that if it gets some good news next week out of earnings with Google and Amazon. That could be enough to get this thing up to fill that gap. If not, and we start breaking under 2800, and we may go back and test that support between 2750 and 2700. That would be a neighborhood on a pullback that it might be reasonable to try to take a shot at it. 2750 down to 2700. Okay, especially again if you're a believer that the market will be continuing higher. The transportation average has turned up off its low, but it is not anywhere near its all-time high right this second. And I keep an eye on that because I do like to see the transports confirming the move. So let's take a look at the transports right now very quickly. And you can see it's only up 2 points. You can see it's nowhere near its high right now. I wouldn't say it's nowhere near, but let's put it this way. It's not making new highs like the NASDAQ did, right? And the Russell. So basically, it's lagging a little bit. And those are your stocks like FedEx, UPS, and those type of companies, and the airlines, Delta, that kind of thing. All right. So anyway, that's what's going on there. Be careful up here near the high of the trading range, 2800 to 2850. If it doesn't get new juice next week, it could have some weakness. And of course, the VIX, like I told you, was down in the 11s. It's at the 13s. If it's going back to the median area of around 15, or if it's going to make a run at 20, the market will be rolling over. If not, like I say, you got to go with the flow of traffic. Okay, turning towards other markets, the dollar. I've been a believer, and I've been telling people that the 115 on the euro, I believe, is going to be the low, and the euro will be higher as we go into the end of the year. Some people have said it could be as high as 130 or better. That's quite a move. At any rate, the president is out there today talking about the dollar's too strong, trying to jawbone it to the downside. If that exactly happens, then this dollar index, which is around 95, 96 area, it could roll over, and that euro, which is trading 117, again, that could be moving up. Invesco has a dollar ETF, UUP, and let's take a quick look at what that looks like right here. As you can see, it's at the higher end here, and can you see it's rolling over off that 25 area? So if you're a dollar index player, start looking at that thing to see if it might roll over. If it takes out 24.75, the odds are going to be increasing. If it takes out 24.50, we could come down and fill that gap at 24.25, and look at all those other gaps that it could fill underneath. So this might be an opportunity right now to keep an eye on that thing. And if you're a trader, this is the kind of turning point that you kind of wait for. Okay, let's turn. That's the dollar index. I'm going to be going at a brisk pace here. So the next thing is going to be on the interest rate front. A lot of people are looking for interest rates to be going higher. The whole world is looking for them to go higher in the U.S., and they have the yields actually been rolling over. TLT is the ETF that people use on that, and though again, it goes down when yields go up, and it goes up when yields go down. So bottom line is recently the yields have been dropping, and so we've gone from 116 up to 122. It's pulling back here and filling that gap. You see that gap has now been filled, and if it stops going down here and it gets above this 122, 123 area, then yields in the short run might actually be dropping rather than going up. So we'll have to see how that works out. But right around here, this neighborhood here should be where it stops if the yields on the 20-year are going to be dropping, and this thing is going to be going up. If you're a bear and you think interest rates are definitely going higher, then this is something that you'd be selling, because as interest rates go higher, this thing goes down. Okay, next one here is going to be on the oil market, and a lot of people use USO on that. Oil had a big pullback as a lot of the countries increased their oil output, basically trying to help Trump keep the his hope alive that he's going to keep the oil and the gas prices lower. This thing here has been trading between 13 and 15 on the oil fund there, and had a big pullback, but it looks like it's trying to fill in that gap just above 13 maybe, and then maybe it could get back on its bicycle after it does that. So it had a bit of a pullback, but I would say as long as it's above 13, the concept of higher oil prices is still on the table. Turning towards gold and silver and copper, they got whacked hard. They are definitely getting hit by this tariff stuff, and this tariff, has caused the dollar to be stronger lately, but that may change. And so obviously you see that stem down there. This may be a time where you might consider taking a look at GLD, because it is at a lower price, but the trend is significantly lower. But there is some gaps above where it could try to pop back up. But the trend is for sure been moving lower, but it is getting a bit oversold here. And so obviously that stem, that low from yesterday around they made the 52-week low yesterday at 115 and change. So if you were a short-term speculator, that would be your line in the sand. And if you want to play it for a bounce, not unlike the US dollar, it looks like there might be some type of a turn here. Too early to tell, really, but the evidence is starting to look like there could be a bit of a turn. And if this tariff is going to cause higher prices on items, obviously that would be more inflation. And of course, that might be more friendly to gold than what's been going on lately. Last thing I'm going to show you is in agriculture. It's soybeans, another victim of the trade situation, as everyone is now going towards soybeans coming out of Brazil. And so I'm going to show you two possible opportunities here before I sign off. And basically, you're looking at the same scenario as gold and oil. Gold and the dollar. Is this a turning point for the soybeans? Well, some people are saying that with $8 beans, it costs a lot more than that for the farmer to make a profit on it. If that's in fact true, as you go into next year, the plantings could be affected, because maybe they wouldn't plant as many soybeans if they're not going to make any money on them. So bottom line is that people are starting to sniff around the soybeans as a potential turning point. Obviously, just like the dollar and gold, may be too early to tell, but this is the kind of formation that you sometimes see when there's some kind of a turn happening. So keep an eye on those three markets: dollar, gold, and soybeans and see if there's any value here as we go forward. Okay, I did go over a couple of different strategies for you to chew on today. One was your covered call strategy. The other was your put strategy, and trying to take advantage of markets that are strong, but also markets that also may have a pullback. So again, in future broadcasts, I'm going to be going over greater details on these things. But for today, that's all I've got to offer. I am going to be coming to you next week as well. So do tune in. And of course, you can reach me very easily. I'm Jim Kenney, and I can be reached at OptionProfessor@gmail.com. That's OptionProfessor @gmail.com. Your comments, your questions, anything you'd like to talk about, that's the way to get a hold of me. And I definitely look forward to hearing from you and trying to help you as much as I can. I've been in this business a very, very long time, and I have a fairly good product knowledge on all the different ways to invest. So I do hope that you take advantage of that and give me an email, and let's see what I could do for you. Until next time, good luck and good trading, and thank you very much for tuning in today.